except silver's undervalued to gold, and I think it's about to do a quantum leap catch up. It would not surprise me if gold goes up just to its ratio normal move of eightfold, like $8,400. At that point in time, silver's $150, $200.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we have a timely and important discussion lined up. We're fortunate to have with us Michael Oliver, founder of Momentum Structural Analysis. Michael, it's a privilege to have you back on Metals and Miners. Welcome to the show.
Great, Gary. Glad to be back.
So, Michael, for decades and multiple market and business cycles, you've been analyzing markets through the lens of structural momentum technical analysis. We're currently in the next great precious metals bull cycle, and after being jaded by starts and stops for more than a decade, there are many right now who are on the edge of their seat, especially with the sharp drop over the last few weeks. They're confused, they're shaken. These metals and miners investors are looking at the long term despite that. What do you hope for those tuning in to our discussion right now that they're going to walk away with after listening to our discussion today?
Well, ignore the sell-offs and just look at a silly price chart of gold or silver. Just for example, back in, remember, silver was capped off at 35 bucks October last year and March of this year, and was in a 1-year sideways range. And when it came back up through 34, we said, watch out, this time it's going to blow, but it's going to get more vertical. It's been a 50% increase in price since then. And 8 weeks prior to last week now, 8 weeks of higher highs, higher lows, 8 weeks in a row. I mean, that's highly unusual. Can't it have a break where it takes out a prior week's low? Is that really a disaster? Now, gold, which is interesting, last week, when silver took out the prior week's low, it refused to take out its prior week's low. So it had 9 weeks of higher lows. Today, finally took out a prior week's low. And it's the end of the world? Let it breathe, okay? It's an opportunity to buy if you're not already in.
Well, that's a good point there, and let's start there. So, what's been happening? I think everybody wants to understand what's happening in precious metals and miners the last few weeks. We have massive volatility. We have big up and down days. Today is another one of those big down days. Sector sentiment and enthusiasm have been taking a beating. Based on your analysis, tell us what's happening here. Is the top or an extended drop or consolidation period or longer than April to August that we saw? What do you see coming after this period finally comes?
I don't see protracted congestion, which is what we had April, May, June, July. You know, at 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week, okay? But right now, we're not at that point. The action last week, to a large extent, put us in a position where, in our weekend report, we suggested that was probably mostly it. Okay. Now, the only problem was gold hadn't taken out a prior week's low. And so we finally did. I mean, that means we got under 4,000. Okay. It's back above there now. I think the cleansing we just had is probably about exhausted. And that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so. Okay. And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. We're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those.
Keep talking and I'll look for that.
Okay. On page 1, we had a technical situation. Yeah, here we go. Spread chart. There you go. Now, what this chart shows, if you can get even closer to it, it'd be good. If not, what it shows is gold going back to about 2013, plotted in its percent relationship to The S&P 500. Okay. The biggest bull market out there right now. U.S. market is the bubble. No other market in the world matches what we've done. Okay. Since 2009 low. But anyway, gold is in decline since its 2011 peak in price, but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low, under 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple of years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months, the spread backed off a bit, meaning gold lost some ground versus the S&P. And then when the recent reassertion of price back out above that 3,500 price level also drove the spread back up. Now, this spread reading you're looking at there was as of Friday, and it's probably backed off a little bit as of today. But at the end of this month is when we plot that final reading. Now, if you're at 60% or higher, and right now we were about 61 as of Friday, and was gold divided into the S&P, 61% of the price. You're at one of the highest levels on gold versus the S&P going back 10 plus years. Meaning, in reality, gold is doing better than the S&P has for the last decade, but nobody notices that. But if you close credibly over that green line, which is now 1, 2, 3, 4-point trend structure, that is a massive relative performance breakout by gold versus S&P. Given the depth and the width of this base, and this is price versus price, so it's effectively a price chart, this has massive upside implications in terms of a shift in the money flows that go into gold and go out of the stock market. We're already seeing that. Gold's up a lot more than S&P over the last year, last 3 years even. So there's already been some money flow, but the average guy ain't in this market yet. And when this thing breaks out, we bet a couple things. One, gold's going to vastly outperform S&P going forward, probably for several years. It's going to be quite dynamic when it first comes out of here. It'll be like a whoosh effect. But you'll also start to get, probably a few months after this breakout, you'll start to get the headline type things that somewhat explain what is already happening. And we suspect those headline type things might be coming from the financial sector, where few people are looking. They're all looking at NVIDIA, okay? But anyway, forgetting the fundamentals, this tech to us, one, gold has been beating the S&P basically for the last 10 years because it's the highest level in that period. And two, it's breaking out, meaning this relative valuation says it's only just begun. It's not not late, it's beginning.
Understood. So when you see a basing structure like this and you see multiple attempts like it did in 2016, 2020, 2024, it backed off. So this is technically the fourth time and it's busting through at this point, although it's pulled back, like you said today, maybe retesting this resistance zone. How likely, what's the probability that when you see a structure like this, that it does break through ultimately?
Yeah. Now that's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure, not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right. Okay. But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going,
Okay.
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 That's,
So based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's
yeah.
inevitable.
Yeah,
Okay.
and it will be soon because this thing is ripe as a beast. And we
Okay.
know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning.
Yeah. All right. So
Okay.
Michael, the miners have taken an absolute beating since this downward move began, yet they're reporting historic Q3 earnings. Very soon, they're on pace to report historic Q4 earnings after that. Momentum and sentiment, they've taken quite a hit, and rightfully so, based on this carnage. But what are investors missing right now, and what do you expect for the miners over the next 3 to 6+ months?
Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5, 6 months ago? No, actually back about in June, okay? It was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40 something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled I doubled plus in a matter of handful of months, and I can't have a sharp pullback. Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, we didn't even get to it this week when we pulled back into the high 60s. That's down in the lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay. You won't be able to catch the big move.
Speaking of bad weeks, okay, let's discuss. I've got a question regarding your proprietary momentum oscillator. So, are there scenarios when an asset is in a bull cycle uptrend? Let's use gold here for an example. It's in an uptrend in the cycle, and for a week or even several weeks, the momentum oscillator drops and closes below the weekly momentum's lower standard deviation band.
Mhm.
In essence, no asset can maintain full exuberance, full momentum all the time, all the way through an entire cycle. So, does it ever happen where for a week or several weeks it may appear that momentum is stalling out? And how do you know that it's not the end of the cycle when you see that, but rather it's just a pause? And
Yeah.
what usually follows after that brief momentum stall?
Yeah, we've had, silver dropped hard 1 week last week, okay, and some follow through this week. So prices only dropped for 1 week, but when we run weekly momentum, which is also in this report, you made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. What I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down on momentum. And you got into what we call an oversold situation with only that one bad week, creating an oversold situation. And whenever we've seen that occur over the last year, there were like 3 or 4 instances of where similar action occurred. That was it. It was over. I don't care how bad that week looked. You didn't follow through in a sustained way after that. You started the turn. So even though it looked ugly, especially to price chart watchers, momentum says, no, you're through. You're exhausted on the downside. And I think that's where we are. And that's the nature of the sell-off you're going to be seeing in the future. It's not this 1 year wide range that silver had between May of last year and June of this year, where you could just draw a line through about $32 and it'd be above or below it for a whole year. Or gold, like 5 months, April through May, June, July, August, sideways recently. That's not going to happen anymore. We're now in an accelerated phase. And in particular, when this particular spread chart breaks out, it not only says is gold going to beat the S&P, but it means the money flow is really just beginning out of stocks into gold, which means what? The verticality we've seen in price lately in gold is just the beginning of that sort of verticality.
Let's talk about how you are talking about the beginning. The previous bull cycle lasted about 11 years, from 2000 to 2011. The one in the 70s lasted about a decade as well. And if you count the 30s, even though you couldn't own gold, you had to turn it in. The miners were a great representation of what was happening.
Yeah.
Homestake mining just went absolutely ballistic during.
It was 1,000%. Yeah.
Yeah. So I think the question is, here we have gold breaking out in March 2024. It took a couple of quarters before silver and the miners followed suit.
Yeah.
Where are we in your analysis in this bull cycle when you consider that the typical precious metals bull cycle does not last for just a year or two?
What might happen in the next year or two might be awesome, though. I think we're going to go into a new reality. Go to the next page, if you would. This is another spread that we're watching we think is enormously important. This only goes back to 2020. If you recall, in early that year, silver about doubled in price, went from like $15 to $30 in 6 months. A lot more than gold went up. So this spread went from 0.9% to 1.5%, which is, huge move. Silver doubled, gold went up like 40% or so during that surge. And then what happened after 2020, price-wise, late 2020, silver bumped 30 area, and it went sideways to down while gold went sideways. Okay, so on a relative basis, silver, that black line there, the black zigzag, is the price of silver divided into a price of gold, ounce per ounce. And silver went from 1.5% of the price of gold down toward 1% of the price of gold. So it's been an underperformer for all those years, though it's been going up in price, admittedly. Now, in the last handful of months, you can see that spread has shot up again, the top chart now. And there's a black line, a downtrend, that we bumped. And this month, we're backing off from it. So we've got a 3-point trend line there to focus on going forward. But we also have the green line. What does that say? That's a level where since 2022, silver has hit 1.31% of gold, 1.31% of gold. It's set a dual top there. If you go through that, it's called a triple top breakout. And we think that's about to happen. When we run, and now I'll tell you why this is important in a minute. When we run the momentum of that spread, which is the chart at the bottom, where we measure the spread in relation to its 10-month average, you have similar looking picture, except that the momentum is already broken out over its downtrend line, and it's bumping the horizontal structure, whereas the spread is not. In other words, momentum is ahead of the spread. It's closer to a full breakout than the spread is. If that momentum breaks out, and it doesn't take much to do it between now and Friday, for example, end of the month, you can bet the spread's going to break out. Now, why is this important? One, silver's cheaply priced to gold historically. You go back 50 years, in bull markets, 79, 80, 2010, 11, especially in that part, silver was over 3.5% of the price of gold, even 6%. In 20 of those 50 years, silver has at least been 2% of the price of gold, even in non-bull market years. Okay, here we are at 1.2%. Even if you just go to 2% the price of gold, that's almost a doubling in the current value of silver. What happened in the latter phase, or the acceleration phase, of the 79-80 silver bull, in the last 5 to 6 months, you went from like under $20 to 50 bang, just like that. In 2010 and 11, silver had already been going up for years, but in late 2010, it doubled and a half in 6 months, from above 20 to 50. What caused silver, which had already been going up, to suddenly say, no, I'm tired of going up that way. I'm going straight up. I'm going to explode. The spread broke out. The same spread situation you have now, you could go back then and look at it. And sure enough, it was the signal that told you once the relative performance of silver gold broke out, you're going to go vertical. Our assessment is when we do logarithmic studies of silver gold situation and the silver moves that occurred in late 79 and 80, if you match the logarithmic scale of what happened in those final 6 months, 2010 to 11, silver went from just above 20 to 50. That means this particular push will take you over 100 to match the ratio scale. Because again, we're starting from around $50 here now. If you go back to 79 to 80, last 5-6 months, silver in the next 6 months could be over 200 an ounce.
I have a question for you on that. Okay, so number one, the inflation adjusted high from 1980 is like almost $200 in today's dollars. So
you make a simple point. Yes.
which makes it really curious that this $50 barrier seems to be so strong in people's minds.
Yeah.
When everything else inflation adjusted is much higher.
Yeah.
But the question, and you can comment on that in a moment, but the question I have for you is, in most of these precious metals bull markets, when silver does do this super spike that you're referencing, that usually marks the end of the precious I mean, it has anyway, right? When we see the gold to silver ratio drop to 30 to 1 or 15 to 1, that was kind of like the bat signal that it was coming to an end. So if we do have this verticality move that you're talking about, this new reality, does that mark the end? I mean, are we that close to the?
I don't think so. This time, I think there's a major difference globally, not just in the silver and gold markets, but they're expressing something. And that is that for about 100 years now, we've been totally on this fiat stuff, okay? Unbacked currencies. Roosevelt took us off domestically, seized gold, and Nixon banned it as a backing for international transactions. So gold was not the backing of the dollar in any respect. That was 79 for Nixon and the 30s for Roosevelt. So we've had fiat for that long. So the Japanese look at their currency. Same with the euro. It's just pieces of paper. There's nothing reality behind it. If that is failing, and we think it is, because it's led to nothing but monetary inflation, which has created what? Ongoing price inflation of certain assets, especially food and gasoline, stuff that hurts people. People get upset by that. And if you break this stock market now and put further pain in the average guy's face, his retirement account drops 20, 30%, and he says, oh my God, his wife gets laid off, okay, et cetera, et cetera. You have a crisis that is broader than just silver and gold. They're expressing an outcome that's going to be different. I strongly suspect that when this event occurs, it will presage a piece by piece, country by country movement around the world out of fiat into gold-backed currencies. But it will take a crisis in pain to cause the public upheaval that will force that change on politicians and so forth. So yeah, I think when you get this surge, and if you're a trader or an investor, you might want to consider especially getting out of call options or leverage positions. But as far as dumping the metals again, I think we're going into a new reality where no, you're not going up to 200 and then back to 50, okay? Go to page 4, if you would. Keep going, one more. Okay, now this shows silver. And if you could back up, we could look at the gold and silver chart at the same time. No, not back up. The same page, but just show both parts of the page, the up and down part. If you can.
All right, hold on one second.
Yeah, take it down to something like a. Yeah, there we go. One more click, 2 more. There you go. Okay, what we have here is a log scale price chart of silver going back to 75 and a logarithmic scale price of gold since 75. Both monetary metals historically for thousands of years. Silver is underpriced to gold, and we can see, you don't have to see the spread chart to see this. I mean, we've been in a 55-decade range of reality for silver. We nipped out above it, and then the feverish public finally said, I got to be in. They goosed it up to 53, and then they bagged those guys, which is justified. I mean, where were you? You know, it just got in. Those old highs are meaningless, as you said, in real dollar terms. They're meaningless. But look what's happened to gold over the 50 years. An eightfold move from the 76 bear low. Gold was about 100 to $850 high. Boom, the first red arrow. Second one is from 2001 to with about $260 gold, went to 1920. Another eightfold move, different span of time. But look, after each surge, there was a new range of reality, the gray the boxes, okay? And now we've started a third move here. If we match the other two log scale wise, it says $8,400 gold, just to equal what happened in those two moves. And given the background events right now, just equaling those would be nominal only. How come silver's still in the box? Do you think it's going to stay there?
I think you make a really good point. In
Yeah.
fact, you also show this with copper.
Flip the page. You'll see it. Next page.
Yeah, I mean, come on now.
Page 5.
There we go.
And lead below it. Same story.
Yeah, I mean, when I was reviewing this, I was thinking, well, this makes a great point. Now the crash, the great financial crash did knock down copper right here. But what's interesting is it knocked it out of the new reality box down to test the top of the previous reality box. And then it snapped right back up into the new reality box to the very top. And it has remained there ever since.
And now you're actually, that's not updated. That's moving out above the top of that reality box.
And it very well might. So that would join gold. Copper would join gold, having
look at the range from the 70s through 2005.
Yeah.
Silver was $50 capped then. Okay. You know, and why is it still there? Okay. Now flip to the chart below. An even more exciting metal, lead. Okay.
Right. Which one? Maybe because of the strategic nature of silver. Combined with the fact that 70%, 80% of all silver is mined as a byproduct, and it's very, very difficult to just start up new silver mines and get the needed supply. And so they've got to protect that a little bit more maybe than some of these others. I'm just guessing here.
Nobody can cap off reality ultimately.
Well,
they may try. I don't care how big the government is. It's coming down, or that agency will come down, or the policy will be proven to fail and they'll give up on it. Nobody can restrain market reality ultimately. You can do it for a while.
Right. It can't be permanent.
If you do that, if that's a factor that has kept silver capped, then it's created even more dynamic in the compression factor that it's generated. So when we come up through there and prove, hey, you guys were wrong, we're going to catch up to reality. Well, those moves were different years, by the way. The up moves in lead was a year and a half behind the copper move. But they both were quadruples in a matter of what? A couple quarters.
So, it's like holding a beach ball underwater, to your point. But also,
absolutely.
When you look at gold's move, you look at lead's move, you look at copper's move, and it's easy to justify. I mean, after the great financial crisis, they printed trillions and they degraded or debased the purchasing power of the dollar, which pushed these things up into a new reality. And then to your point, why has silver not followed?
Yeah, and I'm not going to get into that because I don't know. There are people who argue, and justifiably, as far as I can tell, that it's been manipulated by, banks probably working in collusion with the government or the central bank.
Whatever it is.
I can't prove that, but all I can say is it's wrong. And when markets make major errors, like, every time we see a bubble top in the stock market, we never know it's a bubble. Some people do. Hopefully we do at MSA. But most people don't know it's a bubble until it breaks and they say, oh my God, that was a bubble. Why didn't I figure that out? Well, that's unreality for too long, and therefore, when it compensates, it usually does what? Overcompensates.
Right.
Similarly, in this lead and copper situation, when they were capped so low for so long, yet the money growth was a constant upward curve, and yet they didn't reflect that. They went sideways while the money growth went up, meaning the decay in the value of the money. And they said, oh, I got to catch up to that reality. Whoosh. Okay. Well, silver hasn't done that. Well, I guess it's a dog battle. You and I are wasting our time,
No.
Or a
It's too
market has
critically
made,
important.
or a market has made a huge mistake.
We can't move forward in society without silver. And we're talking globally.
Even
We're not
AI needs silver.
exactly
Okay.
AI, data centers,
Yeah.
robots, the coming robotics revolution, the amount of silver that's needed there. So yeah, no, silver is critically important. So okay, let's take your silver thesis, this verticality that's coming, this new reality that's coming, and let's transpose it, so to speak, into the silver miners. The silver miners asset class is a very small asset class. When money really rotates there in mass, the market caps are just not big enough to contain it, and the positions go ballistic. That is a Doug Casey famous quote. He experienced it
Yeah.
multiple times. Okay, so this scenario of silver miner positions going ballistic, it's happened a few times in history. If your silver thesis entering a new reality is correct, I would presume that the silver miners are in for another cycle where their
Huge. Yes.
positions go ballistic.
Absolutely. Yeah. Probably even more than silver at some point. Scroll down another page or two. I'll show you a chart that will make the point. Keep going. That's Silver Weekly there. And keep one more page after that, I believe. Here we go. There's a chart at the top, shows silver miners versus gold miners going back to 2020. And again, you had the silver miners surge, SIL versus GDX, in that 2021 surge in silver price. It went up a lot more than gold. So did the silver miners. But then since then, the silver miners underperformed the gold miners, GDX. But look what's happened since late 2022. 3 years. You've got a 1, 2, 3, now a 4-point trend line, and you're crowding it. If that spread this week, and already today, for example, GDX is down a little bit more than SIL is. So that helps firm that spread. You close out any month, this month or next, much above that green line, and the number is 94%, divide SIL into GDX, and you have a breakout of a 3-year wide base, slightly declining base, but still a base. That will indicate similar breakout of the silver versus gold spread, which, as I showed, was close to a breakout also, which indicates just what you said. You break these guys out and it's telling you, oh, monetary metals miners, go to the silver guys. They're the undervalued ones. And there's like a vacant field above that chart where you can have open field running when you break out over that green line. Meaning silver miners could handily beat the gold miners on a percent gain basis. And I suspect, given the ripeness of that structure, that's probably what's going to happen.
And if it does happen, then Doug Casey's quote comes to fruition once
again. Yeah.
All right. So, Michael, I want to ask you briefly on this particular topic, the Bloomberg Commodity Index. After the surge in 2020, I can go to it if you tell me what page it's on. Is it further down?
Keep going another one. One more page, I think. Yep, right there.
Right there.
Scroll down. Okay. Yeah, you got them both. Yeah, go ahead.
Okay. So, after the surge in 2020, which goes up to 2022, looks like it makes a double top there. That was following the printing of trillions. It then fell and has been consolidating for several years. Are you expecting the broader commodity basket to be contained range bound for months and years to come? Do you expect it? But here's the big question. What kind of impact in the real world on the real price of goods that everyday people consume will we be feeling and experiencing if this thing comes out of the base and moves higher?
The same is true with many of the key commodity components of Bloomberg. Energy sector, natural gas has been firming sharply lately. Crude oil is handful of dollars below a massive momentum breakout level. So all the components, the grains are starting to firm. Bloomberg is above right now as we speak. It's backed off from the price of Friday, which was 107.37. We're now in the upper 106s. You close out any month this year above 106.52, and we're above it right now with 4.5 days left in the month. This asset category, which is very cheap relative to historic prices, I note on the left there, 238 back in 2008, 175 in 2011. It's trading right now 106, 107, and they call this high. You know, this has begun. This has only begun. That first leg you saw in 2022 peaked 1 month after the Ukraine-Russia war, so that didn't take it up. That topped it. Then you had a 50% pullback, and we based. You'll break out of the momentum base if you close above the 3-year average, which is 106.52, which has capped the action for the last 2 years. In other words, momentum says you're starting another wave, meaning from an investor point of view, one, you have a cheap asset category, especially relative to the stock market, Bloomberg. It's cheap in relation to its old price highs. It's cheap in relation to stocks. And in the past, there are times when the Bloomberg or the CRB index decades ago will follow gold. Not always. For example, 2015 to 20, Bloomberg went down while gold doubled. But now they're in position to follow on the footsteps of what gold is already doing. When is the last time, well, not the last time, but one of the more prominent times this occurred? The late 70s, global stagflation. Stock market was a total wasteland. Nobody made money for a decade. Most of them lost money. Bloomberg exploded on the coattails of gold. Not as much as gold, but huge move. So from an investment point of view, if I were looking for places to place money, monetary metals, emphasis silver, commodity asset category, if you don't like buying commodities, fine. Look at the stocks, fertilizer stocks in the ag area, other stocks in the agricultural area.
So just real quick,
yeah.
I'm sorry, just real quick. What's the impact in the real world for the everyday?
Oh, it'll hurt people because one, they've been promised by the newly elected president that he's going to keep prices down, meaning commodity prices, going to keep oil down. Well, I would say this. One, I think oil is probably going to break out. Already it's broken out over enough structures to suggest it's in process. But 68 monthly close does it, in which case all of a sudden those, quote, cheap gas prices at the pump aren't going to be cheap anymore. And they could go up fairly sharply, fairly quickly. Also, other food prices, which have been depressed over the last couple of years, as the Bloomberg has come back down, grains, for example, are going to reassert themselves. All kinds of assets in the commodity category are going to turn up. So it's going to hurt people and help generate emotion.
What's the probability that the break out of this is actually to the downside instead of the upside?
I'd say like zip. One, if Bloomberg right now were 150, 200 points, up anywhere near those prior highs, I'd say, well, it's more open to that. It's dirt cheap. You have to think about that too. Historically, it's dirt cheap. It is off the page cheap in relation to paper assets. And, perhaps it's been suggested to me by one of our silent partners of MSA that the world is about not just to favor gold and silver, but about to shift its focus again to the real world assets, which as a category are dirt cheap. We've been ignored. We don't care about them. And when this guy turns up for his next wave, the Bloomberg, which means like copper, which is pushing all-time highs again, it's going to impact people. And they're going to wake up to, hey, this is a category that's cheap. It's not going to get cheaper. It's acting well. And all of a sudden, this other category that I've been in for years gleefully has suddenly hurt me 20%. Oops, 30%. It's going to create an entire shift in psychology and perception of what is really of value in my life.
Yeah, it's well said.
It could be a decade phenomenon, where there's a man reverts to the real world with respect instead of disrespect. Okay.
I think that's really well said. Well, this has been an incredible discussion, and I want to welcome everyone who's tuning into this fantastic interview with Michael Oliver, founder of Momentum Structural Analysis. Before we wrap up and go to our asset ranking lightning round, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's also the name of the report you'll get. I'm positive you've been enjoying the conversation Michael and I have been having. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, so Michael, the asset ranking lightning round. I'm going to ask you to rank a few assets, 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give 1 to 2 sentences as to why you take the position. We'll roll through these really quick as it is a lightning round. Okay? You ready?
Ready.
All right. We're forward looking from now over, say, the next 6 to 12 months. On a scale of 1 to 100, is gold a buy or a sell, and why?
100. And it's only in process, early in the process. You break that spread out, it's thunderbolt. You pound the table. It's really going to go. And so I would regard this break as an opportunity for the latecomers, and there are many latecomers.
Okay.
Silver more so.
Okay, so let's do physical silver.
Okay. Same story, except silver is undervalued to gold, and I think it's about to do a quantum leap catch-up. It would not surprise me if gold goes up just to its ratio normal move of eightfold, like $8,400. At that point in time, silver is $150, $200.
Okay, so you have silver at 100.
Yeah, at 100 and in front of gold.
Okay. 1 to 100 gold miners.
Same story. The gold miners are vastly undervalued to gold. I think they'll catch up. And there could involve a doubling to tripling of the asset current relative value of the gold miners to an ounce of gold, could double or triple. So it's a far better place to be than the mama metal itself.
Okay. Silver miners, I'm assuming the same story.
And even a little bit more so than the gold miners, because they'll reflect the ratio dimension of the move, silver versus gold. They will reflect it versus the gold miners. Better place to be.
Okay. Copper. 1 to
Copper
100.
looks good. It's not going to perform like gold and silver, but I could easily see copper going, $7, $8 an ounce per pound. No big deal. Ratio wise, that's not as big a deal as anything the monetary metals are going to do, but it's in a bull trend. I don't expect it to be totally explosive like the monetary metals will be, but strong. It's a good place to be.
So 1 to 100, what would you put it
I'll
at?
give it a 70.
70. Okay. Let's turn over to energy. Let's start with uranium.
The correction we had recently over the last year or so, we predicted. We've been bullish since 2017 when it was around 20. Okay. And it pulled back into the 60s, 70s and base there. I think it's starting to reassert itself back to the upside, but I'd only rank it at about a 60.
Okay. Oil.
Same story. Oil had a huge move in that first move we saw out of the commodity complex, 2020 to 2022. It may not be the leader this time in terms of the dimensionality of the move, but it's going to be strong. It wouldn't shock me to go back again to that 130, 140 zone, but we're already in the 60s. So what are we talking about, a double or so? So I'd put it in that 60 category too, but it looks like it could be very strong.
All right,
and stocks related to it. Yeah. Okay.
Let's go over to the general markets and we'll start with the Nasdaq.
It is the bubble category beyond the S&P. S&P has gone up about tenfold since 2009, thanks to monetary excess. Nasdaq's gone up about twice that much since the 2009. And if you look at relative performance within the market right now and run all the spreads of the sectors versus S&P, they're all in downtrends relative to the S&P. Only one sector is explaining the leadership, and that's tech. It will be the bubble that breaks the most. At one point in the trend, it will go down more than will the S&P. So I rank it as a 0.
A 0. Okay. And where do you put the S&P? I'm assuming not much higher than the
Not
Nasdaq.
much higher than 0. It will go down too, but its dimensionality of decline will be somewhat less because it's composed of other things other than tech, which will go down less than will a breaking AI bubble or tech bubble. Yeah.
All right. So if you had to put a number on that,
I put a 0. I would not want to be involved in the U.S. stock market. Period.
Okay. All right. Let's move over to treasuries. We'll start with short-term treasuries under 2 years.
I don't look at them much. They
Okay.
tend to be more reflective of Fed policy. We look at 30-year T-bonds, the long end, which is relatively unaffected by rate cuts. In fact, you can go back to September a year ago when they cut rates. T-bonds collapsed in price, went up in yield. So totally opposite what the Fed did. They look like an asset that might have an intermediate counter trend rally that will impress some people, meaning a drop in long-term yields, rise in the price, but don't trust it. It doesn't look like a rally that will sustain. Their major long-term trend is down, yields higher. But for now, you might just get one of those times where some asset managers say, oh, got to get 40%, 60-40 rule. Let's buy some T-bonds. I'd rank it as a 10.
A 10. Okay. All right. So we talked a little bit about the commodity complex earlier going up pretty much across the board. Where do you see inflation being, we'll call it middle of 2026 on a percentage basis?
Well, I don't know because the way they calculate inflation, first off, inflation is the decay in the money unit. That's what real inflation is, monetary expansion. But they like to call it price impact on this area, that area, consumer prices, not necessarily raw commodity prices, which do affect those metrics that they look at. So, I might suggest that commodities could easily double or triple in the next year or two in price. But to the extent that that affects their CPI and wholesale prices, I'm not sure what that impact will be. But I'm sure that the CPI numbers they're looking at now will probably double, in this process, if not worse. But again, I'm more focused on the commodity real world components of those metrics.
Understood. So, but if I heard you correctly, if we're at 3% today, you could easily see a 6.
Yeah, you could see something that alarms the hell out of people and creates what? Doubt about certain policies being effective, doubt about who you voted for, and uncertainty, which yields what? Fear.
But wouldn't you expect that after the midterm elections? Wouldn't they pull every lever between now and then to do what they have to do to tamp things down?
Try to.
Yeah, yeah.
Try
Try
to,
to,
but
try to.
yeah,
Yeah.
as if they control anything. Okay. They control the degradation of the money unit. They do a good job at that, ongoing. About every decade, there's a 90% increase in the quantity of money, meaning
Yeah.
a degradation in buying power. So they do a good job. Yeah. Okay.
Okay. All right. So let's talk recession by middle of next year, June, July.
Yeah.
What 1 to 10 probability, 10
Yeah.
being the highest?
Yeah, I'd say the good chance of 10 that you're going to have a recession, or it might even be labeled something worse a year from now.
Interesting. Okay.
But this bubble is the biggest in U.S. stock market history. And when bubbles break, you get a recession. .com, mortgage crisis, 1974, 73, I think the market peaked, crashed into 74 while gold was going up. And recessions came. Usually after the stock market comes down, then you start to see the real recession data. Yeah, I think it's coming. Yeah.
Okay. All right. So finally, the recommended portfolio allocation, as you just mentioned, has been 60-40 for decades.
Yeah.
Only recently are any of the
Yeah.
banks, Morgan Stanley, going
Yeah.
to 60-20-20. They're recommending any kind of gold.
Gold. Yeah.
But it's interesting because I was speaking to a friend who's military, and he was going to his financial advisor the very next day. I said, make sure you ask about gold, and he came. I said they're probably going to say no gold only because he doesn't get paid on it, and he's shrinking his available commission structure by if he recommends gold. So anyway, he came back and exactly what I thought he was going to say. He said so. The overwhelming majority, you talked about it a moment ago, they just are not in gold at all. And if they have any, it's just a small percentage. What do you recommend for gold holdings in a portfolio today with this macro backdrop that we've got?
One, I think that people ought to view gold not as an investment, view gold as money. In other words, if I exit a trade that's, say, leveraged for any particular reason and I want it unleveraged, I don't put it in cash. Cash is what? The dollar. Okay, it's decaying month by bloody month, year by year. It's a negative bet all the time. Never gains in value. So I put it in like gold bullion or silver bullion. Now, yeah, they ebb and flow, but basically, if you go back like to 2000, October. Okay, October 2000 to October this year. Gold's gone up with, I think it's 16-fold.
It
You know how
is.
much the S&P's gone up since then? 4.5-fold. Okay. Okay. So all the talk about the stock market and the money growth has been like 4.5-fold. So
But
S&P's only
surely,
kept up with the decay. If you have gold bullion sitting as cash, that's not an investment. You hold it in cash. Okay.
but surely, if you would have had that money in the money market or your savings account, you would have got more than what gold appreciated, right?
No.
I'm teasing you.
Yeah, no. No, it's cash. It's not money. It's not an investment. Yeah, it does ebb and flow, but when you think about it, so does the dollar is a constant bear market. The yen, the euro, in terms of real buying power.
So what percentage should people move from, financialized assets in this decaying money unit?
I have none. That's all I can say. I'm not going to recommend. We're not portfolio directors or
Fair,
managers.
fair.
We don't
Yeah.
do that. We analyze markets, and my own personal position is entirely in monetary metals and related therereto, with an
Okay.
emphasis on the silver half of that equation.
Well,
Okay, so
that answers that question.
period. Now, maybe I'm nuts, but that's the area I'm in money. Okay, that's in effect what I'm doing.
Fair enough. All right. So, Michael, this has been a wonderful discussion. Would you please share a key takeaway that you want the viewers to keep in mind who are listening, and then let them know where they can learn more about your work and how they can connect with you and find you?
I think the dynamics of markets, all markets, is going to accelerate dramatically, almost now forward. A lot of that could occur in the next 6 months. If that spread breaks out, gold versus S&P, if silver in turn breaks out versus gold, you can beat the table and count the months. You will have a quantum leap situation, especially in silver relative to gold, but in the monetary metals versus any other asset out there. And it's highly likely it's not just that the gold goes up more than gold, but gold goes up while the S&P finally rolls over in a way that is table pounding. So I think that's where we are. And I think it's going to be very fast, and it's not going to be a gradual arm wrestling process.
Makes sense. All right. Would you let everybody know where they can learn more about your work at Momentum Structural
Yeah.
Analysis, how they could find you and connect with you?
Yeah, the website is olivermsa.com. Go there, take your time. We talk about our very unorthodox methodology. We've been around since 1992. First 15 years, we only serviced institutional clients. We expanded that to retail subscribers in 2015. Anyway, so we look at all markets. We don't just look at gold and silver.
Yeah, so I've been a reader of your analysis and publications now for well over a year, and I am so thankful to have the opportunity to be exposed to it. I think if you've been listening to Michael, but you do not currently subscribe, you need to go ahead and make it part of your tool chest here as we're moving through this precious metals bull market and really, the commodity super cycle. There's so many other pieces to his work that would really help you out along the way. So go ahead and check out his work and subscribe. I highly recommend it. Michael, thanks again for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. It's always awesome to spend the time with you. I look forward to having you back on sometime soon. Everybody else, thank you for watching.
Thank you, Gary.
I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's also the name of the report you'll get.